Good afternoon, dear traders. Today we will analyze US dollar against Canadian dollar. So, US dollar against Canadian dollar is currently showing a very illustrative situation in terms of the divergence between classical correlations and actual market behavior. Despite rising oil prices, which traditionally support the Canadian dollar, this correlation has effectively broken down in recent days. The Canadian dollar is not receiving the expected support, and this is already an important signal. From a fundamental perspective, the key drivers are the interest rate differential in favor of US dollar to 25% versus 3.75%, as well as a broad shift of capital into the US dollar as a safe haven asset amid the current geopolitical and macro environment. In other words, the market is currently ignoring local drivers like oil and focusing more on global demand for the dollar. Technically, this is reflected quite clearly. After testing the 1.35 round level, Canadian dollar weakness quickly became evident. This was followed by consolidation around 1.37, which represents a key volume area on the daily chart. From there, the US dollar continued higher toward the next resistance zone. At this point, price is approaching the upper boundary of the range formed back in 2023, which is a critical area. Two main scenarios can be considered: a break and acceptance above the range, opening the way for further upside; a rejection from the upper boundary, leading to a return back into the range and potential correction lower. So it all depends also on all the geopolitics. Be cautious. And overall, US dollar against Canadian dollar currently demonstrates how the market under present conditions is driven less by traditional correlations and more by macro factors and global risk sentiment.